This presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compac Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compac Market Wrap YouTube update for March the 17th, 2025. I'm Mo Ansari, President of Compac Asset Management, and thank you for joining me today. First of all, make sure you click on the button to subscribe so whenever I put an update up, you will be notified and you can watch it at your convenience. Looking at the numbers last week, a terrible week after 2 weeks of down. We're not nearly 4% down in the S&P for the year now. Again, we had gone up in January, now we're back down. And that's how the market will continue to do until we get some clarity on the tariffs. Year-to-date, S&P down 3.85%. If your portfolio is down 1 or 2%, you've got the allocation. If you're down 20 or 25%, you have a problem. So this is where you get the check. If you've got all tech and the Go-Go 7, as they were called, or the Magnificent 7, as they were called, they definitely are not doing magnificently at this time. S&P down 2.23, Dow down 2.98, Nasdaq down 2.4. So we're getting a little bit of a bounce here in the market. We did come back up on Friday. We'll have to wait and see how far it goes. And I'll point out some levels that we need to get above before we can say that this correction is over. Energy, the defensive stocks, utilities doing better. Worst stocks, consumer staples. And we did get retail sales today up 0.2%, less than expected. 2/3 of the U.S. economy is consumption. If the consumers close their wallets, we have a problem. And that is what the uncertainty might cause, is a lot of people to wait and watch and say, look, maybe I won't go take that extra trip. Or the businesses say, well, we're not sure what the demand is going to be, so let's hold off on building that new factory, as it's called, capital expenditures, or CapEx. They might slow that down, and that is the U.S. economy. The U.S. economy, or the U.S. stock market, is not performing as well as the European market or the Chinese market. So it shows that we could have major impact with tariffs more on the United States than on other countries. How will this tariff war end? We've got April 2nd, where we have reciprocal tariffs for everybody. Whoever's got a tariff on us, we're going to put a tariff on them on April 2nd. Will that go through? Between now and then, we are going to see some volatility as we hear statements say, yes, we have tariffs. No, we don't have tariffs. Yes, we have tariffs, but all of this is exempt from the tariff. So it will be a lot of confusion. And one thing that the markets do not like is uncertainty. They can deal with bad news. Markets can deal with good news. They adjust very quickly. But when they don't know what the news is going to be, that is when the market has a tough time adjusting to it. Looking at oil, it continues to drift lower. We saw the interest rates just about flat right here. They ended up for 4.31, just about the same as the week before. So interest rates have not gone down. They've not gone up, but they've not gone down. With the economy slowing, we thought that we might see some slowdown in interest rates and they might come down. But I think at this point, not everyone is convinced that we are going to see a recession. The bond market is not saying that yet. So we'll have to wait and see. One more thing we did see was high yield was down a lot more than the bond market, than the U.S. Treasuries. That is usually not a good sign for the market overall. The dollar has come back down as people say, well, exports could be impacted and imports could be impacted. We'll have to wait and see how that goes with the dollar. The dollar and the deficit are, I think, the long-term problem. And the deficit of $2 trillion that we're spending more than what we take in taxes, so we have to borrow that $2 trillion. Sooner or later, someone is going to decide that you've got to give us a lot more interest for us to lend you this money, the $2 trillion. So we'll have to wait and see how the demand for treasuries go. And that could be an issue down the road. Right now, we're spending just about as much on interest on the debt as we are entire defense spending. Our entire defense spending we're spending that much on interest. So we have to bring expenditures, government expenditures down. They've been expanded dramatically since COVID because we hired so many people, we put so much money into the system. Now that is being drained out of the system. Will the private sector be strong enough to pick up all of the slowdown that we get from from all of the pullback in government spending? We'll have to wait and see if that happens or not. Looking at the economic news, last week we had the CPI lower than expected, PPI also lower than expected, but consumer sentiment dropped dramatically, down to 57.9 on the Michigan Consumer Sentiment. That is one of the lowest numbers we've seen in a number of years. If the consumer gets nervous, then we have a problem. We're going to wait and see. Retail sales expected to be up 0.6, came in at 0.2, a lot less than expected. Last time it was negative, so that is a positive. Auto sales came in at 0.3, expected as 0.3. We are seeing the Empire State, this is New York, manufacturing index expected at minus 1.9. It came in at minus 20. So we are starting to see a lot more slowdown. We do get existing home sales. We do get the monthly numbers. I think the weekly numbers we have to watch is the unemployment number. If that starts to go up, that usually is the last sign that the economy is slowing. Usually when that happens, the economy is already slowed. So we'll have to wait and see how that goes. Looking at the technicals, we had the fifth wave top. After we see 5 waves, you get 5 waves, an ABC or 5 waves to the downside. Seems like we have got wave 1, wave 2 back up, wave 3 to the downside. Seems like we've completed 3 and we're getting a 4th wave bounce. 57.42 is the 200-day moving average for the S&P. We're at 56.95. We'll have to wait and see if we can get back above the 200-day. If not, this could be wave 4 before we start wave 5 back down to the downside. And that usually gets below the wave 3. Historically, that's what we've seen. We'll have to wait and see. Next support is going to be this low, which is 5,400, and resistance is right here at 57.50. Those are the numbers to watch. Today we're having a good day. We're up about 1% in the S&P as I do this update, but we have to get above that 200-day moving average before we can say that yes, or really above the 50-day moving average, which is around 59.42. So we'll have to wait and see if we can get above those numbers before we can say that this correction is over. Looking at the weekly chart, again, we came down to the 50-week moving average. We're back above it today. We're at 56.96. This number is 56.66. That is a good sign, but we need to hold above it for the rest of the week for us to continue moving higher. Otherwise, usually wave 4s are back and forth, up and down. So we could see this back up, back down, back up for a period of time. That's the way I'm looking at it. Nasdaq, sharply lower, started the wave 1 to the downside, 2 back up, 3 down. Looks like we're going to get a bounce here, but 18.4 is the number to watch there. We're at 17.9 this morning, so we need to get above 18,400 before we can say. I still think this is wave 4, and then we get wave 5 again, usually to the downside, which gets usually below wave 3. We'll have to wait and see. Weekly chart, again, we're below the 50-week moving average. My dot plot is negative. When the dots are above the market, these vertical lines are the market, these dots are above, usually that means a pullback in the market as we saw here. And once we get there, as I mentioned a few weeks ago, the dots get above the market, usually we go for about 6 to 8 weeks. We've only been 3 weeks here, so I still think we have more chop back and forth on this market. Looking at the yield on the 10-year, we're back up to about 4.33, the 20-day moving average above the 4.23. We're just bouncing around. I think if the economy slows or there's signs of slowing, we could see this come back down to somewhere around 4.1 or even in the 4% area. I wouldn't be surprised. But if we start getting much below the 3.8, I would start to get worried about the economy. Small caps bouncing up, still terrible performance, got up there, failed. Now we're right sitting at the 200-week moving average, which is 200. We're at 205.98 today. Crude oil just bouncing up a little. I think if the economy slows, oil will have a very tough time going up. Gold chart seems like it's moving higher. It's moved up again. This was looking like a fifth wave top when we started this correction, but now seems like we've extended wave 3. We are at new highs today. Gold is above 3,000 now. Again, as we see more uncertainty and people worried about the dollar in the U.S. bond market, people are moving to gold as safety. It used to be the Bitcoin where people saying that's the new gold. Well, Bitcoin goes down just as much or more than the Nasdaq. So it trades with the Nasdaq, not with the gold market. When Nasdaq corrects, it goes down. So gold is still gold, and I don't quite know that if I'm ready to replace gold with Bitcoin yet. A lot of you young people are, but I'm not quite ready for it. Those are my thoughts. Those are my observations for March the 17th. Again, if you don't have the right portfolio, you're down too much, your portfolio is gyrating way too much, you have the wrong allocation. Give us a call. We'll be more than happy to help. Just send us an email at invest@compact.com, invest@compact.com, or just call us at 800-388-9700, and we'll be more than happy to sit down with you, develop a plan for you, so you have the shock absorbers built into your portfolio so you can handle the volatility. Again, 800-388-9700, and don't forget to subscribe to this channel so whenever I post an update, you will be notified. Those are my thoughts. Those are my observations. I will be back next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.